Now, seeing the sell-off in resources over the last few weeks, many investors have been wondering whether this is a good chance to get involved. But Old Mutual, presenting in Melrose today, have a slightly cautious take on that, and Brian's here to join us and give us his reasons for that. Brian, thanks for your time.
Oh, don't worry.
You've noted caution on resource shares. Just to put it in perspective, many of the deep value managers saying this is a great time to buy shares. I wanted to get your perspective on where we are in the resource boom and why you are cautious on resource counters at this point.
Yeah, for a long time, these shares have shown value. So it's been a long time in the making. We are cautious because of a global slowdown in commodity prices. And typically, our share prices follow dollar commodity prices. And a lot of us have only lived through the last 10 or 12 years of dollar commodity prices, which has been one way, and that's been up. We forget that, for the last 200 years, commodity prices have been in a structural decline in real terms. And we're seeing a little bit of that coming through now. So we're a little bit cautious on dollar commodity prices. We're cautious on South Africa in terms of a lot of the strikes that are happening will carry on. Normally strikes, they happen and a month later it's all systems go, and we're just seeing those strikes taking much longer to work through the system. As well as inefficiency and costs, so labor productivity, electricity productivity and costs. So structurally, we're still cautious. It's difficult to run a fund in South Africa without any resources though. So I'm not saying to you we've got no resources. Right. So we're carrying an underweight position, but where we do have positions, it tends to be in the bigger diversified mining companies such as the BHP Billiton, where you diversify your risk away in terms of your underlying exposures to a lot of commodities, not one single potentially marginal mine,
like a single resource stock.
Yes, yeah. So where we do have resource exposure, it tends to be the bigger, more diversified companies.
You made a very interesting point there. You talk about in real terms commodity prices have fallen. I think that might be foreign to some people considering how we've seen iron ore rally over the last 12 years. Just take us through what that actually means and a bit more detail around the analysis that you've used to draw that conclusion.
Yeah, so the picture I'm seeing in my mind is one that actually comes to us from bank credit analysts. It's not something that we had ourselves, but it's a very interesting graph which shows in real terms commodity prices have been in a structural decline for 200 years, obviously with 10-year or decade-long booms in between. And the reason for the decline is probably because of technology. Getting minerals and resources out of the ground has become easier and more productive. So over 200 years, in real terms, commodities have been on a decline. And right now, we believe that, looking at that graph would suggest that they are one standard deviation away from the mean or the trend line where they should be. So, despite the sell-off in the last couple of weeks, we still think, caution is warranted.
Besides obviously the resources, another hot topic's been consumer shares. There's been a little bit of slowdown there. We saw the figures from Massmart this morning, which were showing growth, not quite on trend with what we've become accustomed to. Any space at all for a retailer in this environment in your portfolio?
This call's becoming more difficult. So as the share prices have rolled over since January, it's becoming a more and more difficult call. 4 or 5 months ago, it was a much easier call to make. We're still cautious on South African retail shares, and we're worried about the rand blowing out a little bit, and rand weakness is not good for these shares. And with the current account of the trade balance and just general caution around the rand, it's a reason to be cautious around that. We're still worried a little bit about the consumer. We're worried about income levels. We're worried about employment, and we're worried about credit granting as well. So there's been a very big run-up in unsecured credit granting. We believe some of that's gone into the retails. And if unsecured credit slows down a bit, I think we'll see a little bit of pressure on the retailers. These shares are highly owned by foreigners at the moment as well, and any disappointment in earnings really sees a big sell-off, and it's just creating a lot more volatility as well.
So you're saying international investors more fickle than our local?
Yeah, and I'm not saying they're right and we're wrong or vice versa. I'm just saying it's creating a lot more volatility. So Mr. Price, I think the market was expecting around about 15% turnover growth. They've come out with 12 or 13%, so they only missed by 2 or 3%, and yet the share's down 15% off its highs. So it's small misses are compounding and going into big share price movements at the moment.
You've been buying Richemont, which has had a great run as well. Just take us through the case for Richemont at these levels.
Yeah, well, it's a topical point because they came out with quite a nice trading update this morning, which has seen the share price up 5% as I'm sitting here this morning. So I wish I was sitting here this time yesterday. But structurally, we see a good case for Richemont. We think a lot of the drivers of that share in terms of wealth and spending out of the East will continue. We don't think the share is expensive. We think the market is implying too negative a view on the cash flow return on investments, and it's a really strong dividend payer. It's a good business and well managed. So we've been picking Richemont up in the last few weeks. We didn't expect this trading update to be as strong as it has this morning. So we're pleasantly surprised to see that coming through.
Is this kind of like phase 2 of the Chinese story now? Obviously, it started with resources 12 years ago, 15 years ago, where some of these companies had almost once in a lifetime type of a period where they've seen their share prices rally. Now you're seeing that the Chinese consumer coming through, different portfolio of things that they want, which could lead to the next boom. Is Richemont ideally placed to exploit that?
It is. If you're right that is the next phase, I think they are ideally placed. There's mixed and unconvincing evidence that we are into the consumer boom as opposed to the industrial boom within China. But even if that doesn't come through, we think there's enough wind in their sails to carry them through. Of course, if you're right and it is the next phase and we're moving into a more consumer-led economy rather than industrial-led economy, well, so much the better. Of course, you get good rand hedge exposure through Richemont as well.
And another one that you've got a rand hedge exposure to is obviously British American Tobacco. The bugbear of most regulators around the world, and yet the cash flows and the profits that the company generates have just been incredible. I mean, why have the regulators, when we talk about the taxes that they get imposed, we talk about the advertising that they're prevented from doing, although you still managed to put a cigarette packet on the on the presentation. But how can they still make money? I mean, it seems that everyone's against them. What's been happening with that business model?
At the outset, I don't believe British American Tobacco is cheap. So the reason we're holding it is because it gives us a lot of other qualities in a portfolio that you cannot get from other shares. So it's a very low risk, good dividend yield. It's reasonably predictable in terms of earnings growth. So that's a lot of the reasons why we hold it. We don't stand and wave a flag saying that it's necessarily hugely cheap. I think the earnings are reasonably defensive because one must remember it's a bittersweet kind of thing. The regulators maybe don't want tobacco companies around, but they get a huge amount of revenue out of them. So they will regulate it to a point and no further because they are so dependent on the revenue that comes from that source. So, although it is being regulated and plain paper packaging is coming into the fore in a lot of countries and people are really trying to take tobacco and cigarette smoking out of the limelight, I think the earnings profile is still pretty defensive. People carry on smoking and regulators will regulate to a point and no further.
So they're almost being, they don't quite want to eradicate them completely, the tobacco companies, but they want to obviously take as much tax from them as they possibly can.
Yes, and that's a delicate balance, of course.
You talk about, I think if we had this discussion 3 weeks ago, you would have said the market's quite overpriced. Where are we at the moment?
Yeah, on a longer term view, I think there's a good case to continue holding equities. Short term, one might argue that on a PE of around about 16 or 17 times, the all share is not looking cheap. Particularly when you start getting into retail, healthcare, a lot of the local shares. Resources, one might say, on a PE basis, is starting to look quite cheap, and that's kind of mean or slightly above the mean of the long term in terms of PE multiple. So we think there could be small pullbacks over the next 6 months or the next year, but structurally I see no reason why equities cannot continue to do well over the next 10 to 15 years. The earnings will grow and we believe that the share prices follow the earnings and there's no reason to think that earnings will decline into the next 5 or 10 years.
In terms of our peers though, and this is where we obviously always compared, is we look at South African investors, offshore investors will look at South Africa and say, well, how expensive is this market relative to a Brazil or an Indonesia or Malaysia, whatever. Where are we sitting globally at the moment?
2 or 3 years ago, that was an easy one. Foreigners identified South African shares, particularly retailers, have been hell of a cheap, and they piled in. We believe that's probably the pendulum has swung slightly the other way. So we think that actually South African shares are slightly expensive versus the Indonesias, the Turkeys, the emerging markets that you can invest in. Of course, there's a lot of reasons to not sell South Africa yet because of the liquidity. So it's a very liquid market. The rand's a very liquid currency. So the foreigners are attracted to that because even though it's slightly expensive, they can get in and out quickly. So, they're faced with different problems in other regions. So I don't think there'll be a strong sell-off from foreigners at the moment because of the slightly expensive position that we think it's at. But it's not as easy as it was for them a couple of years ago.
Last question before we go. We've got top 40, as you say, I guess fairly priced. Is there now the chance, as we've seen in the progression of bull markets before, for more investment into the mid-cap and small-cap space? Do you see that sort of money flowing, cascading down into the lower companies, the smaller companies on the market?
Yeah. The mid-cap space has done well. That's probably outperformed the top 40. I don't have the information here. So it's really lower down than that we're seeing a couple of opportunities. So a couple of things that are screening well at the moment would be an Advotech or an AdCorp. More services-orientated companies. We're not seeing a lot of value in the smaller construction companies as yet. The less labor-intensive companies, the ones where they've got good management teams and a good competitive advantage. But if you're going to go and play in that space, you've got to do your homework. So it's almost more time consuming to go and do a lot of work on shares in that space than necessarily the well-researched, well thought-through, easy to forecast British American Tobacco and SAB. So certainly we're on the lookout for opportunities there, and a lot of that stuff is coming up in our ranking tables, but it's more in the small cap space rather than the mid cap space.